The silver market just sent a signal that most analysts are still refusing to acknowledge. And if you're watching price alone, you're missing the entire story. Because what's happening in silver right now isn't about traders betting on direction. It's about nations preparing for scarcity. Welcome to today's metals briefing, where we cut through the noise and focus on what actually moves markets. And today, the signal is unmistakable. Silver has become a strategic battlefield. Let me show you what changed. 3 weeks ago, silver traded like a commodity. Speculators in, speculators out, standard volatility patterns, price discovery through normal market mechanics. But then something shifted. The volatility didn't increase because of speculation. It increased because of positioning. And when I say positioning, I'm not talking about hedge funds adjusting their book. I'm talking about industrial buyers securing multi-year supply agreements at prices that don't make sense unless you believe access will be restricted. That's the first signal. When buyers pay premiums for certainty instead of waiting for dips, they're not trading. They're preparing. Now, here's where most market commentary goes wrong. Everyone wants to talk about silver as if it exists in isolation. They draw trend lines, calculate support levels, debate whether we're bullish or bearish, but silver doesn't exist in isolation anymore. Silver exists inside a technology war, an energy transition race, and a supply chain competition that involves every major economy on the planet. Let me connect the dots clearly. China dominates solar panel manufacturing. Over 80% of global production. Solar panels require silver paste for conductivity. No silver, no panels. No panels, no energy transition. So when Western nations announce aggressive renewable energy targets, they're not just announcing policy goals, they're announcing silver demand that must be met regardless of price. But here's the problem. The silver doesn't come from where the demand is. Most silver production comes from Mexico, Peru, Chile, Bolivia. Countries that are increasingly being courted by both Washington and Beijing. Because whoever secures the supply relationships in Latin America doesn't just control silver. They control the input costs for the entire electrification economy. Think about that for a moment. The country that can guarantee cheap, reliable silver to its manufacturers gains a structural cost advantage in solar, electronics, EVs, and defense systems. The country that gets cut off pays more, delivers slower, and loses competitive ground. This is why silver stopped being a commodity and became a strategic resource. Now let's talk about what's happening on the ground, because the evidence is piling up fast. First, margin requirements in silver futures have been adjusted multiple times in recent months. When exchanges raise margins, they're trying to cool speculation. But if this were just speculation, the price would collapse after margin hikes. Instead, it's been resilient. That tells you the demand isn't from speculators looking for quick profits. It's from entities that need the metal and are willing to absorb higher trading costs. Second, we're seeing reports of industrial buyers negotiating direct offtake agreements with mining companies. These aren't spot purchases. These are contracts that lock in supply for years. And when companies sign agreements like this, they're sending a message. We don't trust the open market to deliver when we need it. Third, the premium between paper silver and a physical silver has been widening. In normal markets, arbitrage keeps these prices aligned. But when the physical market tightens faster than the paper market can reflect, that gap becomes a warning sign. It means someone, somewhere, is buying metal and taking delivery at volumes that strain the system. And fourth, there's the geopolitical layer that nobody wants to discuss openly, but everyone understands privately. The United States has been working to reshore critical supply chains since 2020. Semiconductors, rare earths, batteries, pharmaceuticals. The goal is resilience. But resilience requires resources. And many of those resources flow through countries that China has been investing in heavily for over a decade, through infrastructure projects, development financing, and trade relationships. So now we have a competition playing out across Latin America, Africa, and Southeast Asia. Not a military competition, an economic one. Who finances the port? Who builds the railway? Who provides the loan for the new refinery? Because whoever does those things gains influence. And influence translates into resource access when supplies get tight. This is the chessboard. And silver is one of the most visible pieces moving across it. Let me show you how this manifests in market behavior. When geopolitical stress rises, gold typically moves first. It's the classic safe haven. But lately, silver has been moving in tandem with gold, not lagging behind it. That's unusual. Silver is an industrial metal with monetary characteristics. When it moves like gold, it means markets are treating it more as a strategic hedge than an industrial input. But here's the twist. Silver's industrial demand isn't falling. Solar installations are growing. Electronics demand is steady. EV production is expanding. So you have monetary demand and industrial demand both pulling on supply at the same time. And supply isn't elastic. You can't just turn on a new silver mine overnight. Permitting takes years. Development takes years. Bringing new supply online is a decade-long process. So what happens when demand is inflexible? Supply is inflexible, and geopolitical tensions make access uncertain. You get exactly what we're seeing now: price volatility that feels chaotic, but is actually rational, because the market is trying to price in a risk it's never had to price before. The risk that physical delivery becomes constrained not by economics, but by policy. Export restrictions, licensing requirements, strategic reserve accumulation. These are tools governments use when they decide a resource is too important to leave to market forces alone. And once that decision gets made, price discovery changes. The market doesn't just clear on supply and demand, it clears on allocation and priority. Now, let's talk about China's strategic calculus, because this is where Western analysts consistently underestimate the planning horizon. China doesn't think in quarters, it thinks in decades. When Chinese policymakers look at silver, they see three critical dependencies: energy security through solar expansion, technology leadership through advanced electronics and semiconductors, and military modernization through advanced weapon systems that require silver in everything from missiles to radar to communication equipment. These aren't optional goals, these are core national strategies, and they all require silver. So, when the United States starts talking about friend-shoring supply chains, about restricting technology exports, about limiting China's access to advanced manufacturing equipment, Beijing doesn't wait to see what happens. It moves preemptively. It signs long-term commodity agreements. It invests in overseas mining operations. It builds processing capacity domestically, and it stockpiles. We don't have perfect visibility into China's strategic reserves, but we have indicators. Declining exports despite steady production. Imports rising even when domestic supply should be sufficient. This is the behavior of a country accumulating resources it believes will be contested. And when both sides start accumulating the same resource, you get market conditions that look irrational until you understand the strategy behind them. Here's what most people miss about strategic competition. It doesn't announce itself with dramatic headlines. It reveals itself through boring bureaucratic moves that only matter in aggregate. A new export licensing requirement here, a tariff adjustment there, a subsidy for domestic processing, a trade mission to a resource-rich country. Individually, these actions seem minor. Collectively, they reshape global flows. And silver is small enough to move quickly, but critical enough to matter strategically. That makes it the perfect market to watch for early signals of escalation. So what should we be watching for next? First, any announcement of export controls or licensing requirements on silver or silver concentrates from major producing countries. If Mexico, Peru, or Chile implement restrictions, even for environmental or resource sovereignty reasons, that's a game changer. Second, increased investment in domestic silver refining capacity in the US, Europe, or China. Refining capacity is a bottleneck. Whoever controls refining controls the supply chain, even if they don't control the mines. Third, strategic partnerships between governments and mining companies. When a state-backed entity invests in a foreign mining operation, that's not just capital allocation, that's supply chain security. Fourth, premium behavior in physical markets. If premiums keep rising despite stable or falling paper prices, that's evidence of physical tightness that the futures market isn't capturing. And fifth, industrial stockpiling announcements. If major manufacturers start disclosing that they are holding larger silver inventories as part of supply chain risk management, that's a clear signal that procurement teams see the same risks we're discussing. Now, here's the uncomfortable question nobody wants to ask. What happens if this escalates beyond market dynamics into actual policy conflict? We've already seen export bans on critical minerals from certain countries. We've seen rare earth export threats. We've seen semiconductor equipment restrictions. Silver isn't there yet. But the playbook exists. And once one side uses a tool, the other side considers it fair game. If China were to restrict silver exports or prioritize domestic users, global electronics and solar supply chains would face immediate stress. Prices would spike, manufacturers would scramble, alternative sources would get exhausted quickly because there simply aren't many. If the United States were to impose restrictions on silver going to China, Beijing would retaliate, probably through rare earths or other materials where it has dominant market position. And we'd enter a tit-for-tat cycle that makes both sides worse off, but doesn't stop, because neither can afford to look weak. This is the risk. Not a single dramatic event, but a gradual ratcheting of restrictions that fragments global commodity markets into competing blocks. And in fragmented markets, the country with the least flexible supply chains suffers most. Right now, that's probably the United States and Europe, which have spent decades optimizing for efficiency through just-in-time supply chains and global sourcing. China has been building redundancy in domestic capacity. That's expensive in normal times, but it's valuable insurance in contested times. So what's the trade here? I'm not giving financial advice. I'm giving you a framework for thinking about risk. If you believe this geopolitical competition de-escalates, then silver's current volatility is an overreaction, and any sustained rally will fade. If you believe the competition continues but stays primarily economic and diplomatic, then silver probably trades with elevated volatility, but within a range, because both sides will try to avoid supply disruptions that hurt themselves. But if you believe we're headed toward genuine supply chain fragmentation with export controls, stockpiling, and prioritized allocation, then silver's price behavior will fundamentally change. It will stop trading like a commodity and start trading like a strategic resource where price becomes secondary to access. The market is currently pricing something between scenarios 2 and 3. It's hedging. It's not panicking yet, but it's not comfortable either. And that's exactly where we should be. Because the situation is uncertain, the stakes are high, and the decisions being made in Beijing, Washington, and Latin American capitals right now will determine which scenario plays out. Here's my final thought. Markets hate uncertainty, but they adapt to it faster than governments do. Right now, industrial buyers are adapting. They're signing contracts, building inventory, securing supply. They're not waiting for policy clarity because by the time policy becomes clear, the options are gone. That's the real signal in silver. Not the price, the behavior. And the behavior is telling us that smart money believes access matters more than price. That's a profound shift. And once that shift is priced in, there's no going back to the old normal. So stay alert, watch the policy announcements, watch the supply agreements, watch the physical premiums, and most importantly, watch how industrial buyers behave, because they have more information about future demand than any chart can tell you. The silver war isn't coming. It's already here. It's just being fought with contracts and capital instead of weapons. And in the modern world, that's exactly how strategic competition looks until it isn't. Subscribe if you want these briefings direct. Comment your thoughts below. And remember, in strategic markets, the price you see isn't the price that matters. The price that matters is the one you'll pay when supply runs out and you need it anyway. That's where we are. That's what's next. And that's why silver matters more than most people realize.